Microsoft is the second most valuable company in the world at $3.14 trillion. Over the past decade, the software giant has delivered stellar returns as they lead the way with their cloud business. Earnings per share have continued to grow, stock price has appreciated significantly, and they post 10% dividend growth like clockwork. However, Microsoft stock just fell as much as 7% after reporting their Q4 2024 earnings. Now, they've already started to make some of that up, and they're only down 3.61% after hours. But including that decline, that would make Microsoft stock down nearly 15% from its all-time high. But were Microsoft's earnings actually that bad? Well, I would argue no. In fact, the results still keep me confident that this earnings growth of the past decade is set to continue well into the future. So today I'll give an updated stock analysis on Microsoft stock, break down the Q4 earnings report, explaining all the positive and negatives, and finally at the end of the video I'll provide a price target and future estimates for where I think Microsoft stock will go. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Also, please sign up for our newsletter if you want to get these videos straight to your email inbox. Link in the description and pinned comment. So first, let's do a brief analysis of Microsoft stock before we get to the Q4 earnings report. As I mentioned earlier, Microsoft, ticker symbol MSFT, has seen significant price appreciation and earnings growth over the past decade. And this is primarily driven by high growth in cloud, notably Azure, which is their #1 business segment. And as I'll explain in the Q4 breakdown, their #1 revenue generator is their fastest growth business, which is a great combination to have. And a lot of this is locked up in annual contracts with large companies and recurring revenue in cloud hosting for software, databases, and AI services. On top of this, they have Office 365, which is now a SaaS company aimed at the enterprise and consumer. And the economics of that business have improved significantly since they switched to that subscription model. And since they're involved in so many large enterprises, they have this inherent growth of seat expansion every time these companies add new employees and need them on their Office plan. And I'll explain the Q4 breakdown how that's transferring to their bottom line. So at the current stock price of $422, pre the dip that I just explained earlier, they had a P ratio of 36 based on the earnings per share over the trailing 12 months of 11.52. The forward-looking annual dividend is $3 per share, which is a 0.71% dividend yield at current prices. Now that's a very small dividend yield, but you have to remember that this is a long-term growth business. So that dividend will keep going up over time, making your yield on cost be larger over time. For example, my yield on cost for Microsoft stock is 1.23%. Revenue per share is growing at an 11.84% 10-year compound annual growth rate. Net income per share is growing at a 14% 10-year compound annual growth rate. This is actually accelerated with the 3-year CAGR being 18.65%. Free cash flow per share is growing at a 10.53% CAGR. And shareholder equity just continues to expand as Microsoft has these subscription cash flows that just continually pile in well above their expenses. And their net debt is always deeply in the negative at negative $60 billion. Then they did the Blizzard acquisition and spent a large amount of their cash. So it's currently $26 billion as of Q3. However, I expect that to go down and down and down over time. The Microsoft dividend is growing at a 10.35% 10-year compound annual growth rate. It's a quarterly payer, and the next payment is scheduled to be September 12th, 2024. And again, this dividend is very sustainable with a 33% payout ratio based on free cash flow and 27% based on net income. It is always in this sustainable range, and they have plenty of cash to reinvest in their business and buy back shares. Since 2005, Microsoft has regularly bought back shares on an annual basis. Lately, this has been around 1% a year. And from a financial perspective, there's really only one concern I have with Microsoft stock, and that's their growing capital expenditures in their data center business. From Q3 2021 to Q3 2024, CapEx has grown from $5 billion to $10.9 billion a quarter. And in this latest quarter I'm about to break down, it expanded far more. However, there is a very strong argument that this is the intelligent investment for Microsoft to make at this time, as they need to be the leader in AI, and it accelerates all of their other business segments. And as I'll soon explain, growth is good at Microsoft. So now let's break down that Q4 earnings report. If you want to use this stock research tool I've been showing throughout, please sign up at dividenddata.com. It'll give you access to all this different data and visualizations to help you find better investments. And the service more than pays for itself. Stick around to the end and I'll provide some price targets for Microsoft stock as well as future earnings estimates. So overall for Microsoft, revenue came in at $64.7 billion for the quarter, which is an increase 15% year over year. Operating income was $27.9 billion, which is a 15% increase year over year. Net income was $22 billion, which is an increase 10% year over year. And diluted earnings per share was $2.95, which is a 10% increase year over year. And if we go back to dividenddata.com, you can see that the last quarter was $2.94, so it's slight growth from Q3. And if we break down this business performance into different segments, you have their productivity and business processes segment, which was $20.3 billion and an increase 11% year over year. This is Office 365 and LinkedIn. Office Commercial grew 12% year over year. Office Consumer grew 3% year over year, so that's smaller growth in consumer and a weaker segment overall. LinkedIn revenue increased 10% year over year. And then you have their largest business segment, which is Intelligent Cloud, which came in at $28.5 billion of revenue, which is an increase 19% year over year. And then within that segment, the largest part of that business is Microsoft Azure, which had revenue growth of 29% year over year, or 30% keeping a constant currency. Now this is massive growth for their biggest segment as a company. Then you have their personal computing segment, which came in at $15.9 billion, an increase of 14% year over year. And this includes things like Windows, their devices, Xbox, search, etc. And the only notable thing here, in my opinion, was their acquisition of Activision Blizzard, which drove up their overall Xbox revenue by 61%, 58 points of which came from the acquisition. So long term, this could grow into a more interesting business, but right now, if you're analyzing Microsoft stock, you are really buying it for the cloud business and then the Microsoft Office subscription product. And if we look at the results for full year fiscal 2024, revenue came in at $245.1 billion, a 16% increase year over year. Operating income of $109.4 billion, an increase of 24% year over year. Net income increased 22% year over year, and diluted earnings per share increased 22% year over year to $11.80. And for such a large business like Microsoft, this is actually really impressive growth in general. It's not anything like Nvidia's insane surge, but this is more reliable subscription revenue, and you can expect these kind of growth rates into the future with a greater degree of certainty compared to Nvidia and other high growth companies. So where were the negatives in this earnings report? Why is the stock down? Well, I identified two reasons based on both what the media is saying and what I'm looking at as an investor. Now let's go to the media. What they're saying on CNBC is that Azure cloud growth is decelerating from prior quarters, and Wall Street was projecting 30% year-over-year growth in Q4. Instead, it came in at 29% year-over-year growth. Now, a lot of you will probably know my response to that, in that 29% growth is objectively still fantastic. And I actually think this chart shows a slightly different story, in that Q4 2023 Azure growth was only 26%, and it's actually grown 3 points year over year. And yes, we're not over 30% anymore like we were in Q3, but 29% is still objectively fantastic growth. But now the narrative is set in place that Microsoft Azure is decelerating growth. Now, they have been there before in 2022, and I don't think this is a trend that will continue well into the future. And in that clip, they specifically brought up Google Cloud, which had accelerating growth during their latest quarter. It was around 28% growth year over year. And remember, in this cloud ecosystem, it's Amazon Web Services number 1, Microsoft Azure number 2, and Google Cloud a distant number 3, but it's catching up and is growing fast. However, all of these have a massive tailwind behind them of hosting software and data in the cloud. This trend will continue well into the future, and all three providers will be a winner in my opinion. So this may seem like a crazy opinion, but I don't think that a difference between 30% year-over-year growth and 29% year-over-year growth is that significant at all. I see all the long-term trends still in play. And from an investor perspective, the main problem I found was related to capital expenditures. This grew to $13.9 billion in the quarter. That is an increase from $8.9 billion in the prior year and $10.95 billion in Q3. So this continued capital expenditure expansion is a growing cost at the company, although I do think it is a smart investment long term, as they need the AI infrastructure in their cloud business. This will help accelerate Azure revenue, both directly from selling AI services, but also from helping all these other softwares get created by making software engineering easier, etc., through GitHub Copilot and other services. And all of this new software will be hosted in the cloud, so it's a virtuous cycle of making it easier for more software to be written at a higher rate, making more of it needing to be hosted, etc. Microsoft is also investing heavily into improving their existing product suite with AI, and this is all down the Office bundle. I believe they're calling it Copilot. And this brings up a point that the Google CEO brought up on their earnings call, in that there is greater risk in underspending in regard to AI compared to overspending. If they underspend, then they could lose their market position and not be a leader in the next big wave of technology. That would have far greater costs than overspending by a few $billions in a year or two. And I do think there's risk they're slightly overspending. However, despite that growth in capital expenditures, free cash flow still grew. Cash from operations was $37.2 billion, which is a 29% increase year over year, and free cash flow is $23.3 billion, which is an 18% increase year over year. So despite this concern I just mentioned, growth is still fantastic, and I see all the long-term path to high future growth still in play. So Wall Street analysts are projecting Microsoft stock to have 15% growth in 2025 of earnings per share to $13.37, and that will be followed by 17% growth in 2026, 18% growth in 2027, and 18.7% growth in 2028. And that will bring 2028 earnings per share to $21.63, which is a 19.5 PE ratio. And I actually think these are very reasonable earnings estimates. And in my own head, I'm assuming around 15% growth year over year. So when you're looking at this 2028 price of a 19.5 PE ratio, think to yourself, is Microsoft really going to be trading at a 19.5 P ratio at that time? My answer would be no, because then analysts will be looking at future growth prospects in the years coming. So I think it's actually far more likely at that time Microsoft will be trading in the 30 to 35 P ratio range. At a minimum, it will be around a 25 P ratio. So if we just assume a 30 P ratio at this $21.63 earnings per share, then Microsoft's stock price would be $648 in 2028. And considering Microsoft's stock price fell below $400 after hours, then this seems like a pretty reasonable price range. And right now, the consensus price target for Microsoft is $424.83. So based on the price prior to earnings, Microsoft was trading at fair value. However, it's about 5% undervalued post-earnings. And the consensus rating among analysts is still a buy, with 34 saying buy, 3 saying hold, 2 saying sell, and 1 saying strong sell. Now, I do think it's possible that the consensus price target may fall slightly post-earnings as the stock has gone down. However, my main takeaway right now is that Microsoft is a great business trading at a fair valuation. It's not overvalued, and it's not deeply undervalued either. It's trading at a fair value. So with that said, I feel very comfortable with Microsoft as the top stock in my long-term dividend growth stock portfolio. I'm up 76% on my position. Most of this was bought in fall 2022, and I have a cost per share of $239.31. However, if Microsoft does go down into those high $300 price range, then I might start to dollar cost average into the company again, buy a share every once in a while. And if the stock in the next couple months does go down into the $330, $350 range, then I'll probably be buying a lot more Microsoft stock. And if you want to see my portfolio live at all times, then sign up for dividenddata.com, where you can get access to my dividend portfolio and the new buys as they come. On top of that, you gain access to the stock research tool I've been using throughout the video, along with other tools aimed at helping you make better investments. So thanks for watching this Microsoft stock analysis, and subscribe to the channel so you can see more in the future.